Hi and Assalamu alaikum. Today's lecture is the second part of International Accounting Standard number 1 presentation of financial statement in continuation with the last lecture. If you have not yet subscribed the channel, please subscribe it, hit the bell icon so that you can receive the updated notification of my uploaded video. And if you have any questions or feedback, you can leave that in the comments area. Today we will be discussing three very important concepts of accounting. These are also called the basic concepts of accounting. The first one is going concern, consistency, and materiality. We will see these things step by step. So let's start with the going concern. Going concern is basically the assessment by the management whether the organization will be able to continue as a going concern or not. If you remember my last lecture, in which we studied the components of financial statements. By the way, if you have not yet watched that lecture, I will put the link of that lecture in the description area. You can watch, and I'm sure that you will be getting a lot of valuable information from that lecture. Here, revising you the little bit from that lecture, we studied about the components of financial statements. The first component was, by the way, there are total 5 components of financial statements. The first component was statement of financial position, that is also called the balance sheet. Statement of comprehensive income, also called the income statement or profit and loss statement. Statement of changes in equity, statement of cash flow, and notes to the financial statements. Now, those financial statements are prepared by the management. Means it is the responsibility of the management to prepare those financial statements. And in those financial statements, the management has to give their assessment whether the organization will be able to continue as a going concern or not. Means the business will be for a foreseeable future. Now, this has to be disclosed in the financial statements. I can relate this thing with one example. There are two companies, Company A and Company B. Company A with the mediocre financial results, but they disclose their future prospects and projects in detail in the financial statements. Company B with the good financial results, but they did not disclose anything. So for me, being the user of the financial statements, I will be more tilted towards the company A because I am seeing the future as well in those financial statements. But as far as the company B is concerned, they did not disclose, so they did not give any picture that what they will be doing in the future. So it is very important for the organization to disclose this thing that the business will not be finished or will not cease to exist. So that statement must be provided in the financial statements, and obviously it is the responsibility of the management. Moving forward, the second concept relating to the going concern is financial statement must be prepared on the going concern basis unless there are chances of the liquidation or business cease to exist or there is no other alternative. Means there are some exceptions, and it is must and mandatory for every organization to prepare the financial statements under the going concern basis unless three exceptions. What are those? The first one is there are chances of liquidation. Liquidation might be either due to any court order, any governmental order, or it can be a voluntary liquidation. So first exception is this. Second one is business cease to exist, means you are not doing the business anymore. The third one is there is no other alternative and you have to close the business. If these three exceptions are not there, then you have to prepare the financial statements under the going concern basis. And if there is any question mark or significant doubt, then what you have to do? Any significant doubt on ability of the entity to continue as a going concern must be properly disclosed. Means we studied three exceptions in the last slide. If the organization is going through either of one of the exception and the management think that there is a significant doubt on the ability of the organization to continue as a going concern, then that organization must disclose this fact properly. In the last lecture, we studied two things. Again, revising that thing. The one slide was related to the user of the financial statements, and second, we studied that what was the purpose of financial reporting standards. And one of the purpose was to secure the trust and interest of the users. So you can watch that lecture. Who are the users and how financial reporting is securing the trust or interest of the user? I can tell you over here. Here, what financial reporting standard did is they asked the organization that if they think or is any significant doubt, means there is still a significant doubt, they are not sure but still a doubt, but they ask the organization to properly disclose this thing, because I, being the user of the financial statement, might be my decision will be different when they disclose this thing. If that information was not available, my decision will be different. But the reporting standard gave the strict guidelines to the organization that they have to disclose this thing properly. So if that thing has been disclosed properly, as a user, my decision will be totally different. Related to this thing, moving forward, there is one more important concept. The basis of presentation and justifications that financial statements are not prepared on the going concern basis. In continuity with the previous two slides, now the organization prepared the financial statements and disclosed that those are prepared, the financial statements are not prepared under the going concern basis. You cannot give just a single vague statement that the financial statements have not been prepared under the going concern basis. You have to give the proper basis of the presentation and justification. And again, I will repeat that the interest or trust of the user has been secured by the financial reporting standard, that the proper justifications were there, and as a user, he went through all the details, and obviously the user want to go with the relation with that organization or not, it's the discretion. Now we completed the first important concept, going concern. Moving forward to the second, the consistency. Items in the financial statements shall be consistently presented and classified from one period to another unless significant change in entity's operation or requirement by law. Means you have to be consistent in presenting and classifying the results from one period to another. But there are two exceptions. If there is any significant change in the entity's operation, means the organization has been expanded, or the operations have been curtailed, vice versa, two ways it can go, or all of a sudden the organization changed the nature of their business. So then you can be inconsistent. But if this thing is not there, then the result must be consistent. Second one is requirement by the law, local law or international law. If they require the organization to present the results differently in the coming year, then they can do. Otherwise, the result must be consistent. I can exemplify this thing with one of the scenario over here is, for example, in 2019, we classified the utility expense in one chart of account. There was one account only called utilities. You know that utilities might be the telephone expense, internet expense, water charges, or electricity charges. We moved to 2020. Now we classified the utilities expense in these things, the internet, telephone, water charges, or electricity separately. We cannot do this. We have to be consistent. We presented in 2019 utility, in 2020 we have to present and classify under the utility. We can give the breakup into the notes to the financial statements, but yes, if the operation of the organization has been significantly changed, the operations are enhanced, then yes, you can sub-classify, but you have to present this fact in notes to the financial statements, that what was the reason of your inconsistency. So again, repeating this concept, that the result must be consistent, presentation and classification must be consistent from one period to another, but there are two exceptions: significant change, or there is any requirement by the law. Moving towards the last concept of today's lecture, that is materiality. Now question is, what is materiality? Being the user, misstatement or omission of items can impact the economic decisions of the users. What are economic decisions means you want to go into the relation with any organization, being the lender, investor, debtor, shareholder. So you are going for the economic decisions. You want an economic relation with the organization. If any misstatement or omission of those items can impact the economic decision of the user, then that amount is material. based on the financial statement size and nature of the misstatement or omission, and judged subjectively. Now, this matter is a subjective matter. Maybe the materiality amount is different for me, or for example, as a user shareholder, I am the user of the financial statement, I am a shareholder. One amount is material for me, but for the second user supplier, that amount might be immaterial for him. So it is a subjective matter, but the main bottom line, or the subject line, is that if the misstatement or omission of those items can impact the economic decision of the users. So this repeating this thing again, that you have to assess this thing collectively. If that misstatement or omission changes my decision, then that amount is material. So, summing up the today's lecture, we studied three important concepts: the going concern, consistency, and materiality. In going concern, we said that it is must and mandatory for the organizations to prepare the financial statements under the going concern basis. If there are exceptions, they have to disclose properly. We said that the results must be presented and classified in a consistent way from one year to another year. Under the two exceptions, the first one was there is any significant changes in the entity's operation or requirement by the law. And last, we studied the materiality, that any items, if we miss those items, or the misstatement or omission of those items can impact the economic decision of the user, then that amount is considered the material. In the last, I will request again to just subscribe to this channel and ask as many questions as you can. I will surely reply to this. Spread the word, and thank you for today's time. Thank you.